Welcome to our channel, where we're dedicated to helping you make informed financial decisions. Today, we have an exciting topic lined up for you, Investing 101. In this video, we'll provide a comprehensive beginner's guide to the stock market. Whether you're new to investing or looking to expand your knowledge, this video will equip you with the fundamentals to start your journey towards financial independence. So, let's dive right in. What is the stock market? The stock market, also known as the equity market or share market, is a platform where buyers and sellers come together to trade stocks or shares of ownership in companies. It is a vital component of the global financial system and plays a crucial role in facilitating the flow of capital between investors and companies. At its core, the stock market provides companies with a means to raise capital by selling ownership stakes in the form of stocks or shares. Investors, on the other hand, have the opportunity to buy these stocks and become partial owners of the companies. By purchasing stocks, investors can participate in the potential growth and profitability of these companies. The stock market operates on the principle of supply and demand. When there is high demand for a particular stock, its price tends to increase. Conversely, when there is a surplus supply of a stock, its price may decrease. This dynamic pricing mechanism is influenced by a multitude of factors, including company performance, economic conditions, industry trends, and investor sentiment. How does the stock market work? Now that we have a basic understanding of what the stock market is, let's explore how it functions. The stock market operates through a network of exchanges, where buyers and sellers meet to execute their trades. Some of the most well-known stock exchanges include the New York Stock Exchange, NYSE, Nasdaq, London Stock Exchange, LSE, and Tokyo Stock Exchange, TSE. When an investor wants to buy or sell stocks, they place an order through a brokerage firm. These brokerage firms act as intermediaries between the investor and the stock market. They execute the investor's orders by matching them with corresponding buy or sell orders from other participants in the market. It's important to note that not all stocks are traded on exchanges. Some stocks are traded over the counter, OTC, which means they are not listed on a specific exchange. OTC stocks are typically traded through electronic platforms or dealer networks. However, the majority of stock trading occurs on established exchanges, where there is greater liquidity and regulatory oversight. The stock market operates on trading days and during specific trading hours. For example, in the United States, the NYSE and Nasdaq are open for trading from Monday to Friday, excluding holidays, between 9:30 a.m. and 4 p.m. Eastern Time. During these trading hours, investors can place orders to buy or sell stocks, and the prices are determined based on the supply and demand dynamics in the market. The stock market involves various participants who play different roles in its functioning. Understanding these key players is essential to grasp the dynamics of the stock market ecosystem. Let's take a closer look at each of these players. Individual investors. Individual investors, like you and me, make up a significant portion of stock market participants. These are everyday people who invest their own money to buy and sell stocks. Individual investors can range from beginners who are just starting their investment journey to experienced traders who actively manage their portfolios. Institutional investors. Institutional investors are large financial entities that manage substantial amounts of money on behalf of their clients or stakeholders. Examples of institutional investors include mutual funds, pension funds, insurance companies, and hedge funds. These entities often have professional investment managers who analyze the market, make investment decisions, and execute trades on a larger scale. Brokers. Brokers are intermediaries between individual investors and the stock market. They facilitate the execution of buy and sell orders on behalf of their clients. Brokers can be traditional full-service brokerage firms that offer a wide range of services, including investment advice and portfolio management, or discount brokers that provide a more streamlined and cost-effective platform for executing trades. Market makers. Market makers are entities or individuals that ensure there is liquidity in the market by continuously quoting bid and ask prices for certain stocks. They play a crucial role in maintaining the smooth functioning of the market by standing ready to buy or sell stocks at publicly displayed prices. Market makers make money through the bid-ask spread, which is the difference between the buying and selling prices. Regulators are government bodies or self-regulatory organizations that oversee and regulate the stock market to ensure fair and transparent operations. In the United States, for example, the Securities and Exchange Commission, SEC, is the primary regulator responsible for enforcing securities laws and protecting investors. Regulators set rules and regulations, monitor market activities, and take action against fraudulent practices or violations of securities laws. Types of stocks. Now that we understand the participants and the functioning of the stock market, let's explore the different types of stocks that investors can trade. While stocks represent ownership in a company, there are various categories and classifications that investors should be aware of. Let's take a closer look. Common stocks, also known as ordinary shares, are the most common type of stock available in the market. When investors purchase common stocks, they become partial owners of the company and have voting rights in corporate decisions, such as electing the board of directors. Common stockholders are entitled to dividends, which are a portion of the company's profits distributed to shareholders. However, dividends are not guaranteed and can vary based on the company's performance. Preferred stocks. Preferred stocks are a type of stock that has certain preferences or priorities over common stocks. Preferred stockholders have a higher claim on the company's assets and earnings compared to common stockholders. They are typically entitled to receive fixed dividends, which are paid out before any dividends are distributed to common stockholders. However, preferred stockholders generally do not have voting rights or the same level of ownership control as common stockholders. Growth stocks. Growth stocks are stocks of companies that are expected to experience above-average growth in earnings and revenues compared to other companies in the market. These companies typically reinvest their profits back into the business to fund expansion and innovation. Growth stocks are popular among investors who seek capital appreciation and are willing to tolerate higher levels of risk. Value stocks. Value stocks are stocks of companies that are considered undervalued or trading at a price lower than their intrinsic value. Value investors believe that the market has not recognized the true worth of these companies, and there is potential for the stock price to increase. Value stocks are often characterized by stable dividends and lower price-to-earnings (PE) ratios compared to growth stocks. Blue chip stocks. Blue chip stocks are stocks of well-established, financially stable companies with a long history of reliable performance. These companies are typically leaders in their respective industries and have a proven track record of generating consistent earnings and dividends. Blue chip stocks are considered less risky compared to smaller companies or emerging industries, making them attractive to conservative investors. Small cap, mid cap, and large cap stocks. Stocks can also be categorized based on the market capitalization of the company. Market capitalization is the total value of a company's outstanding shares. Small cap stocks have a relatively small market capitalization, typically ranging from a few $100 million to a few $1 billion. Mid-cap stocks fall in the middle range, and large-cap stocks are the largest and most well-known companies with market capitalizations in the billions or even trillions of dollars. Market indices and averages. Finally, let's explore market indices and averages, which provide insights into the overall performance of the stock market or specific sectors. These benchmarks are widely used by investors to gauge market trends, compare their portfolio performance, and track the performance of specific industries. Here are a few commonly referenced market indices and averages. S&P 500. The S&P 500 is a market index that tracks the performance of 500 large-cap U.S. companies across various sectors. It is widely regarded as a benchmark for the overall health and performance of the U.S. stock market. The S&P 500 is market capitalization weighted, meaning that larger companies have a greater impact on the index's performance. Dow Jones Industrial Average, DJIA. The Dow Jones Industrial Average, often referred to as the Dow, is one of the oldest and most well-known market averages. It represents the stock prices of 30 large, publicly traded companies that are considered leaders in their respective industries. The Dow is price-weighted, meaning that stocks with higher prices have a greater influence on the index's movements. Nasdaq Composite. The Nasdaq Composite is a market index that includes more than 3,000 stocks listed on the Nasdaq exchange. It is known for its focus on technology companies, but it also includes stocks from various sectors. The Nasdaq Composite is market capitalization weighted and is often used as a measure of the performance of technology-heavy stocks. Sector-specific indices. In addition to overall market indices, there are sector-specific indices that track the performance of specific industries or sectors. Examples include the Nasdaq Biotechnology Index, the S&P 500 Financials Index, and the Dow Jones Transportation Average. These indices allow investors to assess the performance of specific sectors and identify investment opportunities within those industries. That concludes our video, where we explored the fundamentals of understanding the stock market. In the next chapter, we'll focus on building a strong foundation for your investment journey. Stay tuned, subscribe to your channel, and thank you for watching.